I'm going to ask our next panelists to please come up on stage. Phil Sharp, Scott Sheffield, Chris Smith. Dan, you can return to the stage. Yeah. And Antoine Halff, our moderator for this panel. I introduced Antoine earlier, so I won't give his bio again, but please come up, walk behind me. Who joined us in September as a research scholar to lead a research program on the global oil market, formerly with the International Energy Agency as their chief oil analyst, with the EIA, and a really 20-year career that spans government, Wall Street, and higher education. And we're really thrilled to have someone of Antoine's caliber doing research for us about how the global oil market landscape is changing. And he is going to lead a conversation today with a pretty extraordinary group of panelists, and I'm going to let Antoine introduce the 4 panelists.
Good afternoon. So yes, it's a really amazing lineup of speakers, and I could spend the entire session reciting the bio, which is in your handout anyway. So I think what I would say, to keep it very short, Jason, you already introduced Dan. All I would say about Dan is nobody has done more to shape the national and international conversation about energy with your career, but particularly with your seminal books, The Prize and The Quest, which really have framed the framework for understanding energy issues and have been unparalleled, unmatched to this day. Phil Sharp, as Jason said, we're very fortunate to count you as our next newest fellow at the center. You have had an amazing career, and we're looking forward to the new chapter. 11 years at the head of Resource for the Future, which is the biggest, the oldest think tank devoted to energy and environmental issues entirely. But that followed 20 years in Congress representing Indiana from 75 to 95, 10 years at Harvard, including in leadership position at the Kennedy School and leading energy and climate issues. So you've had a tremendous impact, and you've also had, in addition to your government and academic roles, an industry experience with Duke. Chris is also a really extraordinary person with industry experience with Chevron, started with military background, Assistant Secretary of Energy for Fossil Fuels since 2014, but really at the heart of R&D and policy development issues since the beginning of the first Obama administration. And Chris has had a huge role in the government's embrace of tight oil and shale, their benefits and the opportunities that they represent after perhaps a somewhat lukewarm start early in the first Obama administration. But Chris has had a very strong role in bringing climate issues, climate technology issues into the energy mix, into the policy mix, CCS in particular, and also has been appointed by President Obama on the Macondo Commission back in 2008 to 2009. And Scott Sheffield is also unique as the leader of perhaps the most successful shale oil company here in the US. Scott, you had yesterday announcements in connection with your earnings reports announcing key landmarks. Pioneer is one of the only companies, perhaps the only company, that continues to grow its production in the current downturn in prices. And you've hit 100,000 barrels per day of production net oil and 200 gross oil and gas production. So that's amazing performance. You've been at the helm of Pioneer since its inception, having been at the head of one of the predecessor companies of Pioneer earlier on. So it's an amazing lineup, and I think I would like to start, Dan, by throwing back at you some of the questions that you asked Patrick just a few minutes ago. And what I would like to ask you, I think the current downturn in prices is not unprecedented in terms of a price correction. There's a price correction perhaps every 10 years or so in the oil market. There has been for the last 40 years. But this one is a bit different because shale is not just something that has added to supply, but it represents a new business model for the industry. And it has a shorter cycle, a shorter lead time, different capital requirements. And it's been a challenge for OPEC and for conventional oil and gas companies. And what I would like to ask you is how you feel the industry in the US, but also internationally, is responding to the challenge of this new business model, and how OPEC is responding as well, and whether there's any future for OPEC in this context.
Boy, that's a lot of questions together. Let me say, as you were saying that, I was thinking that, when you had the big price collapse, which some will remember in the 1980s, then too you had a new kind of oil that came into the market. It wasn't really new, but it was the notion of non-OPEC, North Sea, Alaska, and Mexico, which added about 5 million barrels a day very quickly, sort of analogous in that way to shale. But of course, the difference with shale, as Scott knows better than any of us, it's just a different production. It's 120 days instead of 10 years to bring a well on. And so it is short cycle. And I think the evolution, when the price started down, it was thought that the shale was really the high-cost oil. And it turns out it's not. It's the medium-cost oil. And that as the market turns, shale will be a very important part for the reasons that Patrick said, because the longer-term projects are not going to come on. They've been canceled. So the U.S. will have a big role in terms of bringing additional supplies into the market in that sort of 2017, 2018, 2019 period. One question is, will they have the kind of capital to finance it as they did in the boom period?
Right. And what do you feel about OPEC? I think you wrote recently in the press, you were quoted as saying that OPEC was irrelevant.
Well, I think I was quoted saying that. I mean, I'm not exactly sure that's what I said. I think I think there have been a number of times that obituaries have been written for OPEC, and I think when it's convenient for the major producers to have a framework of OPEC, then it will become more active again. And I think we'll see another effort in June, when OPEC meets with non-OPEC to get some kind of framework of discussion when it's clearer what level of production Iran has actually gone up to.
Scott, Patrick, just a few minutes ago, was saying that the market is rebalancing and that things are looking up for oil prices. Do you feel there's been a lot of cost-cutting across the industry? Rig counts, not with Pioneer, but with many others, have declined. But do you feel that given the recent rebound in prices and the prospect for perhaps more price gains looking forward, and the efficiency improvements that have been achieved in the shale industry, that the industry has reached a floor in production and will rebound, or are we in for further production cuts?
That's another long question, Antoine. No, in summary, the first thing to set the stage is that there's probably, of the last 5 downturns, going all the way back to 1981, there's more debt in this downturn than I've ever seen. And so when you see major oil companies being downgraded, there's already 62 bankruptcies of upstream companies, adding up to $22 billion. Too many companies were betting on $80 to $100 oil for a long time. And so there's a good Bloomberg article that came out a few weeks ago that I think 10 years ago we had $200 billion of debt of upstream companies in the world. Now debt's up to $550 billion. And so the first thing that's going to happen is that when oil prices get back up to 50 to 60, you're going to see a lot of companies, some are already going to the equity markets, but there's just not enough equity out there for a company to go to the equity markets. They're going to have to sell assets. They're going to have to also use a lot of the extra cash flow to pay down debt. And so I think you need at least $50 to $100 billion of deleveraging before you see a significant pickup in the rig counts. Another key point that we have not seen, the rig count went from 1,600, it's all the way down to 340 today. So it sort of dropped in 2 periods. It dropped to about 900, the all rig count. Now it's dropped to about 340. We haven't seen the effect of the production coming from this second rig count drop. And the EIA has a significant drop in the third quarter of this year, dropping down to about 8.3 million barrels a day. Today, it's a little bit less than 9 million barrels a day, dropping all the way down to 8.3 in the third quarter. So also, another key point, the drilling contractors. I was with all three CEOs in the last week at a couple different functions of the top three drilling contractors. People think that we can just start up and start drilling quickly overnight. They've cut 80% of their personnel. It's going to take them, most of these employees, they have no idea. I've asked them where these employees went, what industries they went into. There's been over 300,000 people laid off in our industry, 150,000 in the U.S., and these people have moved to other jobs. It's going to be hard to get these jobs back. We can't just jump overnight. So I'll stop there, Antoine, to see if that answers your question.
Well, I have more for you, but maybe just a quick follow-up to one of the points you raised. You said there's going to be asset sales, so there's going to be a fair amount of restructuring, perhaps M&A in the industry. How do you feel the industry will emerge from this process? Do you feel that the majors might get into shale or get back into shale a bit more than they have recently? And do you think there's going to be the emergence of larger shale players with perhaps efficiencies of scale, but also more diversified players with assets in the shale play, but very different economic incentives from pure shale players, companies that will have shale as part of a more diversified portfolio and therefore will not necessarily manage shale assets the way pure shale companies have so far?
Yes, in regard to M&A activity, the Permian Basin, you can look at Exxon and Chevron's recent analyst presentations. They both stated the Permian Basin is the best place to be in North America. Secondly, most independents that are out there have done an excellent job of deleveraging their company, and they're all trading at very, very high multiples. So people, but we're all growing, and so we have the best asset in the U.S. The Marcellus guys have the best assets of the gas business. So you got the Marcellus and the Permian Basin. A guy named Rusty Brazil who puts out a morning report. What's interesting, there's only 12 counties in the whole U.S. that make up most of the key assets of all companies. If you just take the best counties in Pennsylvania, the best counties in West Texas, there's only 12 counties that really are the sweet spot. And that's where everybody wants to be. And the only way to acquire somebody, somebody's going to have to pay a significant premium to acquire those high multiples. I just don't see it happening. There's been no M&A. There hasn't been any M&A really activity since 98, 99. You have to develop a lower for longer oil price. So when Dan at IHS is saying we're going to have $80 oil in 2020, and other people out there are saying we're going to swing back, which we will, then there's too much optimism, so we're all going to swing back, so nobody wants to sell out today's prices. And so I just don't anticipate much M&A. It should happen. There's too many upstream companies, and people just don't do merger of equals. A couple large independents tried it, but it's really, really hard. It's going to have to be pushed by the shareholders for that to happen.
Great. Thank you. Phil, I was wondering, after listening to Patrick mention his role and that of the other major European oil and gas companies in advocating for a carbon price, are U.S. companies doing enough to prepare themselves for a carbon-constrained world? And are they losing an opportunity to play a leadership function in this debate?
Well, Antoine, if you don't mind my going back to your discussion of pricing just for a moment, pardon me, since some of us have lived long enough, and I see a few people in the audience that meet that standard, that we've witnessed these changes, and I would just say that when there is an earthquake, geologists do not refer to that as a correction in price. And what we have seen, what we've just been through in the last few years, what we were through in 73 and 86 and 2004, whenever. These are real earthquakes in commodity pricings, and they have powerful impacts, as Scott was just laying out a few of the dimensions. So these are not things that either business, government, or anybody else easily adjusts to. And by the way, they're not predictable. Everybody can say one will come sometime, and they do. But the reality is, in every one of those instances, it defied the conventional wisdom of the time. By conventional wisdom, I mean what industry people were saying would be the case over the next 5 to 10 years, what academics were saying would be the case, what government was saying was being the case. Those, we simply miss it. It is a highly unpredictable thing. And just to give you a minor example of the difficulty of predicting is my limited reading of coming up to the OPEC meeting was the assumption that if they could get their act together, the price might rise. But if they couldn't get their act together, the price was likely to fall. We saw just the opposite happen. OPEC, by the way, has had great difficulty in recent years getting their act together kind of proposition. So you just need to step back and understand how complicated and difficult it is to manage a business, to figure out these calculations in this. But let me turn to the issue of whether the question about whether American business leaders are sufficiently proactive on this within the oil and gas industry. And look, it's a very mixed bag. Some very clearly are. They have it. They already articulate that in their investment plans. They shadow carbon pricing. Some of them are willing to step up to bat in the political arena, even though, given the enormous political difficulty in this country over the last 5 to 10 years on this issue, it was actually a high political risk if you had any other business you wanted to do with the government for them to take these positions. But I think that most of the sophisticated ones and the ones that want to be CEOs 5 years from now and who are managers who want to grow into becoming CEOs understand this is one of the risks they've got to manage because this country is going to manage it, other countries are starting to, and the politics are changing here rapidly. And what we're seeing is that if you don't buy into this theory, as there are a couple people running for office that don't at the moment verbally outside. I think they'll change their position if they ever get elected, but which is doubtful. But excuse me, I'm slowly getting out from under the requirement of very careful speaking as a result of being the head of a research organization. So don't tell them I've got 2 more months and I'm starting to let it loose. But let me go back to the issue. What we have been witnessing now for several years in this country is the inability to get to a policy that has some endurance that is shaping the future on carbon emissions in this country has meant that the outlet for political action is all over the place, and it is coming up and rising up on projects. Doesn't matter whether they're gas or whether they're oil or whether there's this or that. If there's a molecule that is going to warm the earth, those are evil in some people's eyes, and they go and they attack them. Now that opposition is not going to be successful everywhere, but all you've got to look at is the difficulty of building a coal power plant in the first part of the last decade when there were a whole bunch of them planned became nearly impossible. Now, gas was the biggest reason, but also the politics was turning radically against them. The same as with the Keystone pipeline. The same as with the university here facing the challenge on investing its endowment. The same is with the recent attorney generals that are attacking 1 or 2 oil companies kind of things. These are the seeking of political leverage, whether they're rational or not. And what we really need to get on to is a serious conversation in this country about what is the cost-effective way for us to change the projection of emissions as opposed to just battling every project that comes down the pike. Excuse me, I've gone to preaching.
No, that's great, but how does the low price, the price collapse figure into climate policy there? Did that make things more difficult, or is that an opportunity to put in more gas in the system and achieve some carbon savings that way?
Well, here again, it's very difficult to assess. The fact that oil prices dropped usually has meant, with the past history has been that fewer people, that people are willing to drive more, they're less willing to buy the higher fuel efficiency car, and that usually it diminishes takes the edge off of what many would view as part of the answer, at least on the transportation side of things. But we have this very unusual situation with the gas supply that has come into place, which can cut either way. If gas substitutes for coal, it is a major achievement for us in the climate debate. If it substitutes in the electric system for nuclear or for renewables, then we're getting nowhere fast, kind of thing. So this is where policy is going to be important at the state and federal level to help see that we capitalize on this. The other thing I'd say about price is when prices don't just affect markets, they are powerful drivers of politics in this country. And every time we had a major price rise, we ended up getting a major comprehensive energy bill out of Washington. Price rises are like a blowtorch on the rear end of Congress. And just forget any view of them being constipated or paralyzed. They will jump the political fence all over the place in what will be done. Well, the same, unfortunately, in some ways is the opposite. That is that when the pressure's off, there's usually a diminishment of policy. Now, that also opens the opportunity, if we want to do carbon pricing, this is a hell of a good time to do it.
So, Chris, when the shale revolution started in the US, I think it was widely seen, and rightfully so, as something that was really industry-driven, and driven largely by fairly small independent companies rather than by large or major companies. And the government seemed to have no part in it. But the government and policymakers really can have a huge impact on development of the oil and gas sector. And I think one of the areas you worked on has been CCS, and you've been involved in mission innovation. Could you explain the nature of this work and how Washington, how the government can really help reconcile the role of supporting the oil and gas industry and supporting what it brings to developing the economy, and at the same time pursuing the policy goal of climate control and sound climate policy?
Okay, well, thanks. There's a lot there. Let me start by, I guess, challenging some of the premise of the wind-up there in terms of thinking about the shale gas revolution. So certainly, George Mitchell and Devon and other companies had a tremendous role in taking those initial risks of deploying capital, of innovating, of discovering ways of producing a resource that we always knew it was there, shale gas, the basement, the source rock for oil and gas, but we could not do that economically previously. The work that was the predecessor of those earliest investments actually came out of the Department of Energy. The very first horizontal wells that were drilled in order to produce in pay zones, the very first hydraulic fracturing efforts, and this started back in the 70s when it was a crazy era of research. I mean, why would anyone want to spend taxpayer dollars trying to figure out how to pull shale gas out of the source rock? But the very first work was done by the government. That subsequently, that data. You were able to find innovators in the market who were able to find private capital to say, hey, this data looks promising. This data looks like something that we can create some real value out of. So I challenge the notion that there was no government role. In fact, government had the very first role. And for us, a successful project is one that you can start and then stop. Right? So this is an example, I think, of a real success, because once industry takes over, there's no longer government role, and that's exactly the types of projects that we want to do. We're doing similar things in areas like methane hydrates. There's other areas of innovation that's very, very early stage technologies that subsequent to successes in that early risk phase, you can get capital to come in and make real investments. In terms of carbon capture and sequestration, I'll build on something that Phil just mentioned in terms of, it's a mixed bag of collaborators that we have in the private sector. I came into the industry into government back in 2009, and we've seen an early enthusiasm in collaboration around technologies to capture CO2 when Waxman Markey was around, and there were some other ideas that had some real promise for going forward. when the political landscape changed, then it became a lot more difficult to get companies to collaborate with government. And I think in many ways to the detriment of some of the fossil resources, particularly in coal. If you look at the top 5 coal producers, and we're seeing a lot of challenges in that area, but the top five coal producers, $28 billion of market capitalization that's been lost over the course of the last 5 or 6 years. Could some of that gone into carbon capture and sequestration technologies? It probably could have changed the way that we look at the future of decarbonizing the coal industry. But it's encouraging to see in the oil and gas industry, some shadow pricing of CO2 being folded into the economics of projects. I think we'd like to see more of that, because in the future, these are things that the companies are going to have to deal with to make sure that all forms of domestic energy are part of the energy landscape in a carbon-constrained world.
Thanks. There's a few questions coming from the audience, and a couple are, I think, best directed at Dan, at least initially, and they have to do with Saudi Arabia. One of the consequences, not the least surprising consequences of the Shale Revolution and the ripple effects it's created across the oil market has been the dramatic changes in Riyadh, driven partly by that and partly by other factors as well, generational change, a response to the Arab Springs, and so on. But recently, from the November 2014 OPEC meeting, when Saudi Arabia took the lead in deciding not to cut production and to go with market forces, to the more recent moves when MBS announced an IPO of part of Saudi Aramco, there's been tremendous changes and lots of surprises. So people are really curious to know your feeling about whether this policy is going to be successful. Are the Saudis really succeeding in letting the market fix itself in not only not cutting production, but actually increasing production? Is that really driving out the higher cost production from the system? And how truly are they willing to move beyond oil? Is that something, the program of diversification and modernization, deregulation that's been announced, is that for real? What can we expect from it?
That's a multi-part question. I think that, at our conference, some of you may have heard Ali Naimi about 2 months ago, the petroleum minister summarize the policy as, well, we're going to leave the market to the market, and low-cost oil is not going to subsidize high-cost oil. And I think in Patrick's comments, we saw the reaction when he talked about all the projects, the big mega projects that are not going ahead. So I think it is rebasing the market. And Scott, whether it's $80 or whatever it is in 2020, I think at least from the viewpoint of those exporters, they concluded $100 barrel was too high from their own competitive point of view. They thought it was the right price. What Saudi Arabia is doing is, in a sense, also what others are doing. Abu Dhabi has been moving in the same direction. What I think Saudi Arabia wants to do is obviously reform its economy, create jobs for 5 million or so young people who don't have jobs, diversify, be less vulnerable, and I think become a financial power in the world economy as well as an oil power. The timetable is very ambitious. There's a lot that has to happen as to what years this will all happen, when the sovereign wealth fund will achieve the scale they want. It seems that an IPO, it's not going to happen overnight anyway. There's a lot of work to be done, but it is saying, it doesn't want to just live off oil. It needs a diversified economy. And I think that reflects the fact that it's not a country of 7 million people. It's now a country of 30 million people that's still growing fast.
Traditionally, Saudi Arabia has maintained, at least for the last 40 years, a firewall of sorts between the technocrats at the helm of the oil ministry and the oil industry and the royal family. But that kind of fell apart just about a week ago in Doha when Ali Naimi came out with an agreement for a freeze with other producers and then MBS seemed to pull the rug from under him and said, no way, we're not going to do any freeze. Do you see that as a sort of repoliticization of oil, using oil as a weapon perhaps against Iran, perhaps against Russia? Or is it, on the contrary, a reinforcement of this policy of going for more open markets, relying more on market forces?
Well, I think on the specifics, I guess you could say that, Saudi Arabia, you have an activist shareholder, and he's exerting his activism. But I think that, what that Doha, and that points to it, there's a very important factor here. We're talking about the market. But surely, and this goes back again to what Patrick said, he said the geopolitics are not any better. The tension between Saudi Arabia and Iran is enormous. They don't have diplomatic relations. And so what transpired that in terms, basically, I think, as one can read it, Saudi message is we're not going to cut production to make room for Iranian oil in the market. And so this goes, what's happening goes far beyond the oil market. It's really about who's the dominant powers in the region. I think that part of this reflects the fallout from the nuclear agreement with Iran, and that was on evidence last week when President Obama was in Riyadh. So I think that geopolitical context and that tension is a very central point in the oil market right now. Otherwise, among other things, I think an OPEC framework might well be working. The countries would have found a way to work things out. But so I think market share is not just an economic concept here, but it's one that's it has deep political connotations as well.
Antoine, I don't mean to correct something you said, but since we have so many young people in our audience that haven't dealt with these issues before, it just strikes me that the politicization of the operation in Saudi Arabia, there's nothing new about that in terms of their relationship with other nations and OPEC and that sort of thing. What they have wisely done, in my view, is they've always had a highly sophisticated, highly technical, and highly competent run oil company in Aramco. But it's not as if it just operates like it's a market thing over here and the government is over there. I mean, there has always been a strategy that, and who was doing what, I'm not, our fellow here may be much more wiser about that, but I would be careful about the assumption that suddenly now it's become a politicized operation.
Right.
Well,
if I can add one other thing, because you mentioned Russia, I think one of the other features of this, and Patrick referred to it, Russia had said we will never participate in a freeze, we're not going to cut back. Suddenly, Mr. Putin called a meeting with the CEOs of all the Russian oil companies, and he said, I think I'm in favor of a freeze. What do you guys think? And remarkably, they all agreed with him that a freeze would be a good idea. And I think that was a big deal going in there. So even though they're on different sides of the issue when it comes to Syria, you've seen the Deputy Crown Prince went to Russia, pledged $10 billion for investment in Russia, and I think part of the sense of the U.S., their fear the U.S. is disengaging from the region, their fear that the U.S. and Iran are going to get closer, is you see a much stronger dialogue between Russia and Saudi Arabia. The U.S. government was discouraging Americans from going to the St. Petersburg Economic Forum last June. I believe there were like 300 Saudis there.
Right. No, I completely agree that you can't really dissociate politics and oil in Saudi Arabia. But in the last 30 years, the hand of the royal family in oil policy has been always very discreet. And Ali Naimi, for the last 20 years, has been the public face of policy. And there's been very rarely a show of disagreement within the kingdom. And that's the much more public role taken by MBS, and the show of tension internally is very new, I think. So I think we will keep going back and forth between geopolitical issues, Saudi Arabia, and more technical issues and market forces, because that's the nature of the industry, and that's really what's driving the market and the industry today, this tension between Shale Revolution, largely driven by technology and financial factors, and more geopolitical or political issues, the Arab revolutions, and so on. So the next questions are for Scott. And again, it's a multiple question here. I just group a couple. One is about hedging strategies. Are companies sufficiently hedged? I guess your company looks pretty well hedged, and its hedging strategy has been quite efficient and quite successful. But how does the rest of the industry compare? And what will it take? How high does the price need to go for shale production for growth to recover and to resume?
Yes, on the second question, I'll answer first. I testified in Congress on the export ban. I used some good slides to show that U.S. at $50 is sort of a sweet spot where you can stabilize, in my opinion, the fall off of U.S. production. You're not going to grow it at $50. It's going to take $60 plus, maybe as high as $70 to get U.S. production to start growing again. Maybe it's 300,000 barrels a day. Maybe it's 600,000 barrels a day. Depends on how much the world needs. And most of it's going to come from the Permian Basin because the Eagle Ford and the Bakken had already flattened even prior to the collapse of oil prices. So the world's going to be more volatile in regard to oil prices. In my opinion, we're not going to have a period of 5 to 6 years of 70, 80, even if it gets to 60 or 70 or $80, it's not going to stay flat for 5 years. There's just too much things that could happen in regard to, it's going to create more volatility. So the people that hedge the best, including Pioneer, we picked up about $2.5 billion of value in hedges over the last 3 to 4 years. Most of it's been realized in the last 2 years. And we're trying to protect the capital budget. It's amazing to me that most large companies, I'm talking about 30, 40, $50 billion companies or greater, do not hedge at all. Some say they have downstream, that's their hedging vehicle. But I know for a fact that now with this collapse, how fast it happened, how many companies have been downgraded, that people are going to change their hedging policy. They're changing it already. It'll take us several quarters to see their financial statements, but people are hedging more and more in the marketplace. They will continue to hedge more. And secondly, they're going to change their debt to cash flow targets. So too many independents operated at a 2.5 to 1. So take your debt divided by your cash flow is about 2 to 1 or 2.5. Pioneer has always operated between 1 and 1.5. So if you see a collapse, worst case, you go to 2 to 1 if you're at 1. But many companies were operating at debt to cash flow of 2, 2.5, and so you go to 4 to 5. And what's interesting, the OCC just came out recently and stated to all the major banks in the U.S. that if your debt to cash flow is 3.5 or greater, you got to reserve capital again, and it's non-performing. And so we have this $100 billion of private equity out here in the marketplace. They're having a hard time doing deals now because they can't get the returns anymore because they can't leverage 70%. They're going to have to leverage maybe 30, 40% from the banks and have to put up 60, 70% equity. So those are the couple changes that I see happening over the next cycle, the next 5 years.
One of the ways in which government policy has played a role in the oil and gas sector has been through the regulation of exports. So Chris, I think you had actually a very key role in turning the supporting policy to turn the U.S. from a LNG importer into an exporter. But last December, I think it came to many as a surprise that the previous restrictions on crude exports were lifted. And Scott, how do you feel about this? Does the lifting of the ban on crude exports change the situation for you and for the industry?
No, I generally traveled, the last 40 years I traveled to Washington probably once a year. I probably traveled 30 times in 2 years, maybe 40 times in 2 years. And I was surprised how we had as much trouble, the industry, with the Republican sides, educating them as the Obama administration, and also the Senate and the House. So we had to educate everybody because everybody forgot about the law in 1975. So we had to educate everybody. We first got condensate approved as a processed liquid. So Pioneer was the first company to export condensate back in 2014 in the summer. The news broke. And then we started working on regard to crude export ban. And at the end of the day, I knew it was going to take a trade because in the industry, we trade all the time. And so we ended up trading solar and wind tax credits to get the export ban, so all sides win. So it's a good deal for the U.S., and when we start growing U.S. production again, we're exporting now probably somewhere 200,000-300,000 barrels a day.
If you don't mind, I do a commercial for my research organization. About 2 years ago, they did one of the early studies that said this.
Mention the name of your research.
Resources for the future. But our economists and scholars said that it was just not going to cause a price rise. It's an anachronistic policy that's left over from the 1970s. And by the way, there are various ways around it. You export products, you don't export oil, crude oil. So it was left over from the high-tension days that we're going to desperately try to be self-sufficient in some way, and it really, I think, is a step forward.
Yeah, the Center on Global Energy Policy also produced a report on this issue a couple of years ago that had, I think, an impact on the debate about this. A question for Chris. What do you make of the growing movement calling for keeping oil in the ground and opposing leasing pipelines, etc.? Do you see that as a valid strategy to reduce hydrocarbon use?
So, I mean, we're certainly not advocating any strategy for reducing hydrocarbon emissions by keeping oil on the ground. That's not a position. Let me comment just very briefly on the back and forth on exports. The Department of Energy, we don't oversee oil exports. That was a congressional issue that's now been resolved and probably will not have an enormous impact in this price environment. We do oversee natural gas exports, which is a truly new opportunity for the United States. I was just down in Sabine Pass on Monday of this week, and I saw many of you here in the room down in Louisiana. Amazing outcome of I think an important project, not only for the region, not only for the U.S. economy, but also for the world economy. So that's a process that's changed a lot over the last few years. I've had the opportunity to testify before Congress on 15 separate occasions since I got here in 2009. About half of those have been on this one issue on LNG exports. And I think, interestingly, I think it's an issue that's now getting somewhat less attention. As there was at one point a fear that by exporting additional quantities of LNG that you would be increasing the price that American consumers pay for natural gas, and certainly we've seen certainly in this price cycle that has not been the case. So important to see that not only does industry evolve to changing conditions, but also the processes that we follow with the government have to evolve as well.
I think we're getting close to the end of this panel, but I have a question here which really is for everyone, particularly Scott and Dan. It's about financial access for oil and gas companies, and were you surprised by the relatively low cost of capital for unconventional oil and gas companies, and has that been really a major factor behind oil and gas development, the Shale Oil Revolution, and is that critical, is the depth of the financial market critical for future developments in this industry?
Start. I think I've already commented on that, Antoine, but there was $20 billion of equity raised last year for upstream companies, $12 billion so far this year. So the equity markets have been opened, but there's probably needs another 50 to 100 billion of deleveraging by these upstream companies in the U.S. So they're going to have to do it. They can't just do it with the equity markets. And then the private equities I mentioned, there is 100 billion plus out there in the marketplace, but it's being constrained by this new OCC ruling. That's going to prevent them from getting their right returns. And so you're not going to have a lot of assets move. Now, once oil prices move up, I think you'll see some assets start to move at some point in time.
I remember a couple of years ago when Bernanke remarked at that point when the shale oil and gas was very much on the upswing, that he said it was one of the most positive, and then he said it was the most positive thing to have happened to the U.S. economy since 2008. Clearly, the economy has moved on, and the energy industry has moved in another direction. But I think if you would say that the shale development in the United States has been a very big beneficiary of QE2 and very, very low interest rates and access to capital to build up those kind of numbers that Scott described.
Could I just comment on the why we got to shale, where there was sort of this debate about market and policy, and both are very important. But it's also, I think, very important to understand where prices were around the year 2000 in natural gas. But they were out of sight. They were going up. The market was supercharged. So those entrepreneurs that were wise enough to take the risk and get out there, and those investors, they really had a golden not a parachute, but incentive out there, which later the gas prices came down, and now you're dealing with a much more difficult marketplace. But some of our colleagues sometimes forget the power of price, but it's also not just that we have a nice steady price, it is the fact that we have these radical swings, which we haven't learned how to control, and believe you me, the debate has gone on for 40 years about how to get steady pricing without having the government own everything, and it hasn't worked. But that was a supercharge, which, by the way, most of the major oil and gas companies did not participate in until very, very late. Toward the end of that decade.
I mean, it's, now gets forgotten. But people like Sharif know this very well. But in 2003, the National Petroleum Council study was all about getting the United States ready to be the world's largest importer of LNG. But a combination of technology and markets just turned that around.
And we were still in 2005 energy bill, the 2007 energy bill. Most people were still operating under that theory, even as late as that.
And in that period, we had 40 LNG import terminals that were sitting before the Department of Energy. So that was the debate at the time, how many of those should be permitted. So that's turned itself on its head.
Given this turnaround, how quick does the government see low prices? I mean, normally, you think low prices are good for consumers, good for the economy. We haven't really seen low prices stimulate the economy to the degree that they might have in the past, given the price
Well, that's a question we have to address in each one of our public interest determinations that we make when we're looking at providing a company the opportunity and the ability to export U.S. LNG to non-FTA countries. So we have to look at a wide variety of factors, impact on the economy, impact on jobs, environmental impact, impact internationally, how it supports our allies and trading partners internationally. So there's a very wide range of factors we look at. But certainly at one point there was a concern that exporting LNG was going to cause us to link prices domestically with prices in Asia at the time were in the teens, not in the high teens in some cases. And our analysis showed that wasn't the case. We didn't believe that allowing companies to take advantage of this opportunity would have that negative impact on consumers. But indeed, in every one of our orders, we do have to look at the impact of American businesses and families who are enjoying these low prices. And indeed, I was just down at West Hackberry at one of our strategic petroleum reserve sites yesterday, and talking to some of the folks there, and it's right near the Sabine Pass terminal and near the Freeport terminal, and lots of conversation there around the booming job market there in that part of Louisiana. It's a tremendous opportunity for folks who are looking for jobs and for companies who are looking to employ in those sectors. So those low prices, it does cut both ways.
Antoine, I think that one of the things that is implied in your question is I think you started to see around the world a concern, even in industrial consuming countries, that if oil prices are too low is also a big problem as are oil prices that are too high. And I think one of the two of the puzzles out there is why haven't low oil prices been a bigger stimulus to the economy, and why this strange correlation between the oil price and financial markets and stock markets, and I think maybe still to be explained. Next panel. Exactly.
It's been a fascinating conversation, and I think we could go on for a long time, but we're running out of time for this section of the symposium. So please join me in thanking our panel